that you allow people to join your casts in this way. I
Absolutely.
think that's brings a lot of the show to
Yeah.
life, so to speak. Yeah,
We're live now. Let me just do a quick introduction.
of course.
So welcome everyone. Thanks, Bulldog Savvy, for joining early. So I'm with my buddy Tim. He's a subscriber from Netherlands. I know we have some people from Netherlands who follow this channel. I know pretty active in the live stream. So hopefully they'll join. So Tim just emailed me. Well, initially I made a comment on my channel saying if anybody wants to join the live stream, let me know. You're more than welcome. And it doesn't matter if you can't even spell the word stock or you are a stock genius. It doesn't really matter because we're just talking, and you're going to learn no matter what stage you're at. Because I'm learning too, as Tim is, but we have different starting points. So that's the whole point of watching my channel is you could learn about finance and accounting. But I want to introduce Tim because I don't really know him that well. Just from his comments and this few minutes we spoke, but I'm sure I'm going to know him really well at the end of the live stream. Just give us a
For
little
sure.
background, real high
Yeah,
level.
so my name's Tim. I'm 26 years old. I live in the Netherlands. And roughly 2 years ago, I came into contact with investing. So I started working at an investment bank called Bank in Amsterdam, the heart of the finance sector in the Netherlands. And everybody around me was investing because they had to have an account for work, and they were also playing a lot with their own money. So that's how I came into contact with it. So at that point, I wanted to teach myself how to do it. So that's what I've been doing over the last 2 years. So I watch a lot of YouTube videos like the audience. I watch you, I watch Everything Money, Monish Pabrai, all of those people who post videos on YouTube. And then basically open an investment account and started doing it for myself. And besides that, I study history, and I'm gonna work in that sector in a year when I'm done with my master's degree in history. So that's a little bit about my background. Yeah.
What's the name of the
Um,
company you work at?
Bank. It's
Is it
part of Saxo Bank now.
right here, Bunk?
No. BINCK.
Oh, Bink
Uh,
Bank.
yes, that's it. So
Oh, that's interesting.
it was sort of a bank for more of the low level investors like myself. So they just allowed everyone to have an investment account, and they had different departments for investing. Basically, they didn't have any credit for just like a normal bank. It was only focused on investing. And after that, they got acquired by Saxo Bank. So I worked there for a while because they had to merge all of the investment accounts. So it was a lot of customer calling and then figuring out what they were doing with
Yeah.
their accounts, etc. It was something to earn some money between my educations. So, but when I was working there, a lot of the when you're starting out learning something new, you can't really tell the difference between the pros and the people who are just doing something, you know. So there were also a lot of people just investing in Bitcoin or unprofitable companies. So I basically made all of the investment mistakes that one can
Yeah.
make because you don't know what you're doing at the start, and it's kind of only after a while that you start to try and protect yourself against ignorance, and try and learn more about it to avoid painful mistakes. And well, now I can still make those mistakes when I'm younger, but if I reach your age, it will be a lot more painful. And most
Right.
of those mistakes are not the mistakes of buying a company and then losing a few $100s or euros on it, but more uh, knowing something about a company or making an investment and then selling it too soon or selling it or not buying it at all. Because you can have just like 10 holdings and 9 of them can go to zero, but if you have a 10 bagger or a 20 bagger, you can already make up for all of your losses. So, and this bank is just like a little bit different from Bank or from the other American companies. It was a little bit like a normal bank, but then an investment bank. So it was less digital than the online platforms that you have nowadays. So they still had a very big customer department and everything. They were trying to help people with that, but after that they got rid of that, more or less, because the people with less money, they earn a lot less money on that, those companies. So that's the kind of the thing that's going on with these banks.
Yeah, it's
So
interesting.
yeah. So I don't know how you got into investing. I'm quite curious.
Well, I think like most people, I've always, you always think about ways to make money. And so I was always trying to like hustle, make money. I was like a paper boy for 5-6 years. I used to, sometimes I would buy things and sell to classmates, like sports cards, things like that. So always hustling. And then, so from an early age, probably like in high school, I started following the stock market.
That's quite
I didn't really do any due diligence. I just looked at the ticker and was like, just looked at like the stocks that went up and down each day. I would see like Berkshire Hathaway. I'm like, wow. I remember it was $17,000 for a share when I was looking at it. And everything
Those
else
were the
was
golden
like,
times.
yeah. And I was like, who would spend that much money on one stock? That's crazy.
Yeah.
I wish I put all my bar mitzvah money into one share of Berkshire
And you don't
Hathaway,
understand the value behind it, because you just
Yeah.
think it's so much money, but you don't understand what's behind the price. It could be more
Yeah,
valuable than
exactly.
something being $1. So yeah.
And my first job was I was an intern at First Boston, an investment bank in Manhattan. Ironically, I don't know if anybody remembers this. Ironically, I started at First Boston right when it got bombed. The first World Trade Center bombing was in 1993. Before 2001 was a big deal because, a lot of people died and it was all over the news. But in 93, that was the first World Trade Center bombing. 7 people died in that one. But I worked in World Trade Center right. I started just right when they bombed it. It wasn't that big of a deal because it didn't really cause much damage at the time, but it did leave an impression with me because so that's when I started in First Boston in 1993. There was no online platforms to buy and sell stocks. So
you had to go to somebody to call somebody, right?
So I opened up an account. What I did, the way I did it was, there's these things called inter-office envelopes. You would put like a message inside and you would write the name and department of the person. So I would open a brokerage account with the form. I put it in the envelope, and then one of the people who worked there, like the runner, he would take the envelope and bring it to the trading floor. And then they would open my account, and then I would call to place a trade. So my first stock was Nordstrom, the department store. And I had no idea what was a good stock to buy. I just overheard another trader talking about it. So I just bought it. And then I don't think I held it that long. But it's just it's kind of like when you get started, you don't even know where to start.
It's more about learning at the start.
Yeah, there's a flood of information coming in, so you have no idea what's going on, but you just got to stick with it. Even if it feels futile, like you're not learning, it's eventually it starts to click. And but you do have to at some point, and it's a little painful, but at some point you do have to kind of dig into the financials a little bit, and try to. But with online now, like when I started my channel in 2020, I was good enough to have my own channel, I guess, but I didn't think I was that good at understanding things.
It's more about doing stuff than actually thinking it out completely.
But the more I did it, like when I like, if I was going through a video and it talked about like, an asset impairment. Like I kind of knew what that was, but I didn't know how to explain it. And then maybe I wouldn't explain it that well the first time, but I pretty much used Investopedia. I still use Investopedia to learn a lot.
Exactly.
Like if I'm not sure, like, I know what asset impairment is, but how do you explain it? Like what? And so I would just go through Investopedia and just read about it, and then try to regurgitate what I read, and then eventually it becomes your own. But now you have there's just all these people out there with the YouTube channels that you can learn from. So what other channels do you follow, Tim?
So I watch Everything Money. I also watch Monish Pabrai. He publishes his videos. And then there is at Dataroma, there are some people who I watch videos from. You've got Guy Spear, but I don't watch him that often.
What's his name?
And then there are Guy Spear. I watched some videos of Bill Ackman, not that often though, and Terry Smith. Terry Smith is a good one because he teaches you a lot about just focusing on quality companies. And Chuck Aker, I think those are kind of in the same league in that regard. And then there is one that I'm looking for. He also invested in Wix. What was his name? Rob Fennell and Pat Dorsey. And Rob Fennell is somebody who is from Switzerland, and he was mentioned one time by Monish Pabrai as somebody to look out for. So an interesting investor. So I watch those videos, and often at certain stages, what I do is I cross-reference a lot. So when I watch a video from you or from Everything Money, or you also got More Money or somebody else, when the stock goes down a lot, like for example with Meta, then everybody the right channels start to talk about that stock roughly at the same time, because it becomes interesting.
Yeah.
So then you can really tell that could be a good deal, and that really is something to differentiate the good channels from the bad. I think. So those are the ones that I follow most often.
How about that Meta? Money,
yeah. So Meta I sold too soon, unfortunately. That's a bad thing.
Everybody knows I'm super bullish Meta. They're my favorite stock. I bought Meta at the first day they started trading for 40. I remember, and then and people at my work were saying, "Oh my God, why did you buy it? It's overvalued." And then I was down 30% after a couple of weeks.
And then it takes some time. Yeah.
And I didn't want to sell it. I was buying covered calls just to make some money, and then it got called away. I think I sold it at I think like 200.
200 before a crash. Yeah.
But I have a lot of it.
And you bought a house with it, right? That's what you said on one of your videos, and then bought it again because of the crash in the 2 years ago. Yeah.
So in May 2017, I bought a lot in my retirement account at 150. So that's always been up, that 150. Then when I sold my business at the end of 2021, I sold my business in December 2021. So I had $500,000. And the only stock I could think of that I was confident about was Meta. And I was like, I should just put it all into Meta. And I didn't. I put 100 into Meta because it was already down 20%. It was like 3,875 was the peak, and I picked it up at 339. So, and I was down like 65% at one point. And I'm like, oh my God. I can't.
Excruciating.
I hate Meta, but I'm like, thank God I didn't put it all into Meta. I would have lost all my money. And I put a lot into Johnson & Johnson. And Johnson & Johnson was up like 20%. I'm like, oh, I should have put it all into Johnson & Johnson. And then, but now what I look at, my Johnson & Johnson is down like 15% from when I bought it in 2021. And my Meta is up like 25%. So it just shows you it's a waiting game sometimes.
It is, yeah. It is.
Wow.
And sometimes that's the difficult thing nowadays, because the amount of information overload is even more insane than it was when you started investing. So it's more difficult, I would say, for your patience. It really tests your patience. And a lot of the brokers, they have a platform where it's a little bit gamified investing nowadays. That's what I would say. It's almost like Tencent had an influence on how to, shape investing as a game. So that's more difficult nowadays for people like me. And because you're used to your smartphone that much, you're used to making these quick decisions, and then
absolutely
you copy that to investing, which is a detriment.
Absolutely. Bulldog, you should follow Bulldog. He streams 24/7. He's always live, 24 hours a day.
He's always live. Wow.
Always live. Well, he has other people with him, but it's always live at any point in time. He's live streaming. He does finance. But Bulldog, you bought at 92. Brilliant. What did you sell at? The thing is with me, if I like a stock, if I feel confident in a company, I usually don't sell unless I need something if I need like food to eat.
That's a good attitude. Yeah.
But I have sold, like when I started my business in 2012, I sold a lot of my stocks, so I had the funds. When I wanted to pay down my house, that was back in 2020, so I sold then. But generally, I don't sell unless I need the money for something. Generally, I don't need money to pay rent. I have savings. But obviously, if things come up, I'm thinking about doing another business. So yeah, I haven't sold my Meta. I have sold some stocks. I sold my Intel maybe too early because I lost faith in the company.
Yeah, me too. I made the same decision. But sometimes it's better to lose a little bit of money than to wait and have it go down even more. So that is probably the right call, even though
it's hard because
you lose money on it. Yeah.
Exactly. When do you sell?
So that also making that distinction between selling a winner and selling a loser. I mean, I sold a winner in Meta, but sold a loser in Intel, and then.
Oh, you did too? You sold Intel?
I had Intel, and I also lost faith in it because I thought they lost their main position as a chip manufacturer.
Yeah,
and because of their technology, it's really hard to come back from something like that. And also because they're such a giant company, they have to turn around a lot of things. And if you're big, that's more difficult to do than when you're small. So it could take years. And in that time, they will probably underperform the S&P 500 or other companies like Meta. So then it's better to cut your losses short and focus on something else. Yeah.
Here's one investment, sell into strength. Here's one investment that doesn't fit my investing profile so much, but I had funds in my Roth and I lost like 30-40% on this investment. I can't remember what it was. So I put it all into Nubank. It's a Brazilian fintech, and it's up 121%. I just happened to catch it at the bottom. I think the bottom was like 380. I caught it at 420. So this is great investment. I'm up 121%.
True.
Yeah. And
you looked at it because Warren Buffett owns it partially, or because banking is something that I don't usually do because I don't understand it.
I think that helped. Yeah, I think that helped. I just I wanted something riskier, not as safe.
Okay.
And I just like the so if anybody ever questions my investing ability, this is proofs. So in my retirement, I picked 4 investments, and so 2 of them are beating the S&P 500 because I also, this is back in 2017. So I'm up 92% in S&P, but my Berkshire is up 125%, and my Meta is up 213%. So 2 out of 3, I'm beating the S&P.
Very good.
This PDP is not.
What is that? Is that Pinduoduo? No, it's not.
This is an index. I'll show you the portfolio. It's just a basket of companies. Apple happens to be the biggest, just because I think it should be mostly mid cap companies, but Apple Apple was a small percentage of the fund, but Apple grew 10x, so it ended up becoming the largest part of the fund. But it's mostly mid cap. I think 10, 20 billion market cap companies. O'Reilly Automotive. Yeah, Microsoft toppled Apple.
But this is an interesting one because don't they rebalance assets, or is it just you buy it like this and it stays the same, the holdings? Because normally what would happen is that it
they rebalance, right?
They shave off. So
yeah, but it looks like they haven't rebalanced yet.
That's really good.
I've seen it like this for a while. And my cash or my brokerage, I finally got Meta. It's not doing as well because I've been trying to do some riskier stuff. The only thing that I'm unhappy with is Johnson & Johnson, because 2 years ago I bought it. It's down 8%.
It's fine. It's 2 years. It's fine.
It fits my investing profile. These 2 on the bottom don't fit my investing profile, but I'm trying to just do something different. This is what happens when you do something different. You lose money. I'm getting crushed on PetMed Express. That's down 52%. This stock, AbCellera, I keep dollar cost averaging down, and I'm just getting killed, down 32%. I put 50K into it, and I'm down 16K. So I'm just going to wait it out. I like the company a lot.
It's a little bit like you're trying to copy Nick Sleep now. You know him?
Who?
Nick Sleep. He is something that Monish Prabhat talked about a lot because he bought Amazon. He basically had an investment fund. He closed it down because he said, I'm going to return all the money to my investors. Just buy Berkshire Hathaway, Costco, and what was the third one? Amazon. And that was like 15 years ago. And then like a couple of years ago, he was super wealthy. And then he sold some Amazon holdings and bought ASOS in England, and that went down like 99% or something, just because he diversified to something silly.
Yeah,
but he's still fine.
Exactly. I mean, I'm not gonna, I'm not gonna not eat because I'm down AbCellera. But yeah, but in my wife's investment account, I have a lot of Costco and Amazon. So that's why I don't have it here.
Holdings. Yeah.
Instead of, I bought Amazon for her, I bought Meta for me. Amazon though isn't doing that well. It's only up 20% in 4 years. It sucks.
True, but that's one to basically when the world starts to move a lot more to the cloud, then it's
You
one
just
of
gotta
those
wait.
divisions they have. Yeah, it's one of those divisions they have. And you also did Mueller Industries, I saw yesterday or today. So then
Yeah,
you saw the stock flatline for a while, and then it just went up like a rocket ship in 2 years. So that can happen to a lot of stocks.
yeah, Mueller. That was an
Yeah.
interesting one.
Yeah.
Somebody requested that. I have a on Patreon or YouTube. If you pay $20 a month, you can choose a ticker, and I'll do a video on that ticker. So he was one of the people who did that. Of course, anybody can choose a ticker. I can't guarantee I'll do it. I
Yeah.
might do it, but if you pay 20, obviously I have to do it. And this is a stock I wasn't even too familiar with. It is interesting. It's an interesting company. I remember. So Tim, tell us what are your favorite stocks?
So the ones in my portfolio, or the ones I'm looking at.
What companies do you have? And you might not even own it. There's some stocks I love, but for some reason I don't own it.
True.
So
Yeah.
what companies do you really like, have a lot of faith in, whether you own it or not?
So for example, I own Academy Sports. You did a video about that stock as well, and I bought it when it
Academy
was at a
Sports.
P of 5. Yeah. So that's a interesting one because it went well public in a very interesting way. And I saw that there was a lot of value there. I also look at Adcore, Kafco Industries. They build houses. Then there's a Games Workshop in England.
What's it called?
Uh,
Kafco, you said?
Kafco, yes. CAVCO.
Oh, Kafco.
Kafco Industries. Yeah. So
Okay,
they
yeah,
build a lot of
I think I heard of
houses in
them.
the United States. It's not a home builder like a traditional home builder, but they build these houses that they move on trucks and then place them somewhere. So it's more like movable homes and stuff.
Yeah.
So they have like localized factories where they build your house and then it's moved to that location and placed there. So they try to be a solution for the housing crisis in the
Yeah,
United
like
States. Yeah, and a
like
competitor,
mobile or repurposed homes.
affordable homes, exactly. So a home is like 200,000 instead of 500,000 normally.
And those homes are
That's what they
very,
say
very
about.
efficient. If you
Yeah,
buy those,
yeah, true.
like the because regular homes that we live in aren't that efficient. Like air seeps in. Sometimes there's, you get a flood or you get like water dripping. Those homes are built really well, but people don't want to live in like a plastic home. But they're generally a lot more efficient and better built.
And there is a lot less material waste with these kind of homes because they can build them in a factory, so everything is controlled. So that's why it's an interesting one. And one of their competitors is owned by Berkshire Hathaway, so that tells me that it's a good industry to be in.
Yeah.
And it went up
Yeah,
quite a while, quite a
nice
lot in a
revenue growth.
true low debt, good management, and it's a mid cap. So it's still small and it can grow a lot.
3 billion, lots of room to grow.
Exactly. So this one I didn't buy when it was at $200. I was still figuring out a lot about investing, and I saw it on the Magic Formula site.
Okay, yeah.
So yeah, so this is one I keep an eye on. I don't own it, and I also own Alibaba because I think it's a misunderstood company. It's more like a combination of Google and PayPal and all of these other companies than an Amazon. So, and it's one of the leaders in a quite a fast growing economy. So I own that one and Tencent because they are basically a China ETF. And
Yeah, if you guys think PayPal is big,
Yeah,
When you
Alipay is
compare
even bigger.
PayPal to Alipay, Alipay is like 10x PayPal.
Yeah.
And the reason Alipay is so big is because of Alibaba. They do all the transactions. And that's really why, that's the real value of Alibaba is Alipay, the transaction part of it, because
True.
that's a lot of the profit is in the transaction fees. It's very scalable business.
True. And it's often misunderstood because people think, oh, they have all of these, they went down a lot in COVID, they have to pay all this money, but they have synergies between their different divisions. So they have their commerce business, which is used Tmall and Taobao, but they also have this this smaller business, Signio, that does all of their logistics. So those divisions, they help each other out, and they can basically run the entire commerce business in China if they want. They could handle that at some point.
And cloud computing, I'm sure you guys are familiar with cloud computing. That's really the future of a lot of things. And Alibaba Cloud is 6% of the cloud computing market. It's
true, yeah.
And it's a big market. Amazon Web Services is number 1. Microsoft is number 2. So that's why I'm surprised Amazon stock hasn't been really growing.
Well, that's because they have all of that's the same problem with a lot of these combinations that have different divisions. So they are basically like a painting, but you have to buy if you have want to buy a painting and it's really nice, but then you also have to buy a second painting that you don't want with it. So then that brings down the price because it
That's
basically
a good analogy. Yeah.
it basically tops it. It basically brings something with it that you don't want, and that's why it brings down the margins. It brings down the returns superficially, but under the hood, it's a really good company.
So you heard it here. If you want to make a lot of money in the stock market, you don't have to buy a small cap stock. I bought Amazon at 112 in May 2020. In May 2020, 112, and it was up a lot. It was up like 50% after a few months. And look how it came down so far. It doesn't matter if you didn't get it below 100. Right now, it's still trading below its all-time high. And with the cloud computing market, it's gonna triple in the next 5 years. There's so much growth potential with AI in a cloud market. So Amazon is a really, really good value. You just have to wait, and it's hard to wait because I remember with Meta. I'm very bullish Meta, and when people were buying it, I remember in 2021 when people bought it in the 300s, because I started my channel in 2020, so people bought in the 200s, 300s, and then I was getting a lot of negative comments like, "Oh, I lost all this money on Meta. You don't know what you're talking about," because it was down to below 100. And I'm sure, like a lot of people, a lot of investors do this. Hopefully, you don't do it. But if you do this, I get it. Is that you say you put 10K into a stock, and it's up 20%, and then after a few months it's down 40%, and you just sell out because you can't take it, the pain.
Yeah.
And then you see it go down more and more, and you're like, oh, thank God I sold it, because I would have been down another $3,000-$4,000. And then before you know it, you would have been up. You would have probably doubled from your original investment, but you don't hold out. So if you buy a good company, you got to hold it.
And I think that's the most difficult thing to do, I would say, for me as an individual investor. That is one of the hardest thing to do psychologically. So
because
even though I'm quite a good stock picker.
Yeah. It doesn't matter if you do all the due diligence analysis in the world. You're going to be down, and I was down a lot. Remember, I put 100K into Meta over here, and I thought it was a good buy because it was 20% down. So I was happy. It was 20% down. And then I was down 60%. And I was like, God damn it. I feel like such an idiot. I act like I know so much and I'm down 60%. But in my heart, I kind of knew it was going to come up, even though I was a little nervous. But I didn't, if I was that nervous and I lost faith, I would have sold it. I didn't sell it. And you saw I was up 50% on my Meta, because not my original Meta where I bought it for 150, but so I still made a 50% profit, but you got to hold out. I'm just pissed I didn't buy it when it was below 100. I get so annoyed. I don't know. I should be happy I'm making money on Meta. I'm just upset I didn't buy it when it came down.
And James has quite a good question. Have you tried using AI or ChatGPT to analyze balance sheets of stocks?
That's interesting because no, I haven't. I can't imagine that's going to be good because I use AI for like certain things, like give me a good title for this video.
Exactly.
But which that's usually helpful, but when I use AI for things like a little more esoteric, I think the results are pretty crappy.
They are gonna be a lot better in a couple of years, and you have screeners, right? So you can do the due diligence for the balance sheets of the stocks with a screener that looks at the debt to equity ratio, and that takes care of a lot of the problems. So you can just say, I want a stock with a return on equity of 20%, and it has to have low debt, and it has to have grown in the last 5 years with a revenue of at least 10%. It has to have earning per share growth. It has to have all of these things, and it's basically better than using AI at this moment in time. But in a couple of years, it might be the other way around.
Yeah, maybe. I can't imagine for complex things. I could see it being a little beneficial. It kind of leads you in the right direction.
Mm-hmm. Yeah.
One of my screens. Okay. Yeah, I could see AI giving you like some information where you could start like the process, but I'd be interested to see. I'll try it on my phone.
It's at this moment in time, it's better to use your own instincts than to use AI to analyze a stock. Because it could even be that the AI is programmed by Microsoft, and then it says by Microsoft for some, and it could be that Microsoft's earnings are declining, and then they only programmed it to just have you buy the stock. Just
yeah, James brings up a good point. Like, how do you the thing is, like, we don't have infinite amount of money. Say you have 50K to your name, which might sound like a lot to some people, might not sound like a lot for other people. And even if you have, it's hard to sit on cash. So what Meta was, I guess its peak before this big run was 350. I don't know. So like, at what point, like when it goes down to 300, do you put your money into it? I mean, say you put 10,000 at 300. I generally don't sit on cash. So the problem is when something crashes, I don't have the cash unless I sell something else, which I did do.
But that is when it goes down a lot, then you start, and you're completely invested, then you start comparing, relatively speaking, instead of buying for example, when you can buy Microsoft at an earnings of 2, but Johnson & Johnson is at earnings of 10, then you sell your Johnson & Johnson and buy more of your better holding. That's kind of the way to go in that scenario.
Yeah, I mean, that's what I try to do. But generally, when my stocks go down, usually most things go down, I'm invested in. Not like one thing goes down and everything goes up. Like for instance, I always wanted to get into Netflix, and I was going to buy it in 2012. when and then I never did, because I liked it a lot, but that's when I started my business, so I didn't really have the extra funds. And then it ran up to almost 700. So I was like, I missed that run. And then I bought it at 388 in January 2022. So I thought it was good because it was down almost 50%.
And then it went down even further. Did you sell out like Ekman?
And no, and then I bought and then I was down 50%. So I'm like, so how do I get money to buy more? I'd have to sell something else to buy into that. So it's hard to know. And then you get scared because it's hard to buy something that's falling. I knew it was a good investment. Fortunately, I'm up like 40% or so now, maybe 50%. So it's good. But like, how do you catch the bottom? You really can't. I guess
no,
you
and
can.
It's futile to try because it will.
It is, yeah.
Because it's gonna force you into bad thinking. For example, foregoing investing more into a good company because the price has gone up, or waiting too long and then seeing the price shoot back up and never investing. And those are costly mistakes that even people like Warren Buffett make. The famous example is where the price of Walmart went up on him like 10%, and then he was like, I'm not gonna buy it because it went up 10%. I'm gonna wait. And then after that, it tripled or something, and he never bought it. But at that point, it would have still been a good investment.
So, it would have, yeah.
Yeah.
Because at what point do you buy Apple or Microsoft? You can't, because they never go down. Well,
and
Apple
they're never going to go down to a PE of 10.
Yeah,
probably.
I know.
So they look really expensive, but then are they? That's the question. So
I've been talking about shorting Apple. I don't know if you guys remember that live stream. But it's just like, you really have to catch it. It's almost impossible, actually.
So, but why do you try? Why do you want to short something that can only, you can make 100% on it, but your downside is endless?
That's true.
So why do you try?
Then in your theory, you should never short then.
Exactly. Yes. Never.
I just saw, like there's this game on A Price is Right, called Over Under. So they flip over a card, and if it's like the 4 of hearts, then the contestant says higher or lower, and then most people would say higher, and say it's like the 6 of diamonds comes. Then you would say higher or lower. Most would say higher. So I think like Apple is like at a queen. Of course you would say lower because there's so many cards below a queen. All the numbers and the jack is below a queen. But a king or ace could come out still from the deck. So that's where I think Apple is. They're a queen, and can it keep going higher and higher? I mean, I just thought I saw more downside than upside.
It was the same with Tesla, and then Musk tweets something about I'm going to buy back more shares, and then the stock price goes up, and then you are closed out of your short position, and you've lost all of your money. So that's the danger with stocks. They don't behave in a way that is similar to a card game. That's why I never try it, because it's not predictable in the same way.
Sure.
It's far more lethal.
But Tesla's not a good not nearly as good a company as an Apple.
True.
They're highly inflated stock. But
True.
Somebody was asking me on the last live stream, why do you like Meta so much? And I think I tried to answer them. I don't think I had the best answer, and I thought about it more. And I think the best business is a business where you can add customers at low expense. So
that's a good analogy.
once you have a good base, a foundation, it's easy to add. So a company like Tesla, it's to add a new customer. It's not super expensive, but it's still a cost because each car has to be made. So it's not. So there's still infrastructure in place. They, even though they have all the factories built and they have the employees in place, each car is not that expensive to make, but there's still a decent cost to each car because you need the materials to make the car, and you have to actually make the car and deliver the car. But the reason I like Meta so much is they built the best website in the world. Maybe Google, you can argue Google is better, but because they have the most people going to their website, them and Google, they have billions of people going to the website. So it's just, and they sell ad space. That's how they make. Google and Meta, 99% of their revenue is selling ad space. So they don't really, to get new customers, they don't really have to do anything. Just take their money. Because the platform's already built. Of course, they're always improving the website. That goes without saying. But the foundation is built, so it's just all it's all scalability. It's all profits.
Well, there's another factor, and that's for Meta, they can raise prices, or in theory they could, for their ad space every year, which is, they have some sort of pricing power. But for Tesla, you buy a car and you have the car for 20 years, but you bought it in the price of that year, and in the meantime they can't raise the price for you because you already bought a car. So you acquire a customer for 20 years, but they only make that expense in the year when you buy the car, and not every year when you use the service or product. So that's something
Yeah,
that a lot of companies, they don't have
that's a
that
good point.
pricing power.
That's a good point.
Yeah.
Um,
Which is why I really like recurring revenue companies like
yeah.
Meta. Yeah.
And I had a business with recurring revenue, so I know it pretty well. So the best revenue is revenue where you automatically charge someone whether they use your product or not, like a gym membership. If a gym only charge people when they go to the gym, no gym will be in business because they can't make money. They have to charge you that monthly fee, and in a sense, they're forcing you to go to the gym. Some people still won't go even though they're paying, but the idea is if they're paying, they're probably more likely to go to the gym than not. Where if you only paid when you went to the gym, you'd probably go once a month, maybe. But if you're already paying, you're probably going to go 3-4 times a month, ideally.
And they don't care if you don't go because it's just free money. So
yeah, they want you to go because they want you to stick around at the gym for a long time.
Yeah.
But if you don't go, they don't lose anything.
Exactly. Yeah.
You may quit your membership at some point. That's a risk, but they're making money. And remember when websites started to become popular and everybody wanted to build their own website and make money and sell ad space, but it's so hard to get people to go to your website. Like, if you built a website, say you knew everything about world history. So you built a website talking about world history. So people who wanted to learn about it go to your website. You need a real specialty and a real niche. And it's hard. It's hard to get people to go to your website. And then it's just as hard to keep people on your website for a long period of time. Where Meta really is the best at it in the world. They have people on the website sometimes for several hours at a time. There's really no other website as successful as Meta with doing that.
They are basically, that's why smoking was such smoking, like British tobacco or other companies that sell cigarettes. They were, they were the Meta of of the past, 40 years or something, because it's kind of like the Meta is basically the equivalent of digital smoking for a lot of people, because it's so it's addictive. Basically, that's what they're selling, an addictive product. So that's why it's also so successful. And I'm not saying you should buy companies that are just addictive, but it's one way why they're so successful.
Well, it's a great, that's what, tobacco, cannabis, alcohol,
gambling,
gambling, addictive products are good as an investment because people can't really live without it. Of course, the reason tobacco stocks are artificially pushed down is because there are certain funds and people that will not invest in it because of the negative. But as it just from a pure business standpoint, it's a great business model. Exactly. Razors and blades business model. Razors and blades. What's the other? There's another. There's another type of thing. It's not reason. What's a pick and axle business model?
Yeah, the shovel, picks and shovels.
Pick and shovel.
Yeah. So selling the shovel for the gold miner. Something like that. Yes.
The razor and blade. One item is total players give away for free in order to increase, like a loss leader. That's a thing in for aircraft manufacturers. They sometimes lose money when they sell an aircraft.
The aircraft, yeah. But they make money on the parts.
They make money on the servicing of. Then that's why during COVID, these aircraft companies were losing so much money because the planes weren't really flying, so they didn't need service. Because making an aircraft engine is expensive, but servicing it is almost free. You just have to pay a person to go and actually service it, but you don't have to go through the whole process of making it, building a factory, parts, having insurance.
And it's often the aircraft manufacturers of the parts, they are very insulated, because it's quite often the case that, for example, you have a door manufacturer of the Boeing, and then that company is the only company that makes the door. So they can't go bankrupt, because then a lot of airplanes can't fly, or they can charge a very high margin. So often the companies that have the airplanes, they're not good investments, but the companies behind that industry, they could be.
No, it's just something to think about when you invest in stocks, because a stock is a company. So, and it's just one extra layer of thing to think about. But just because you sell ad space on a website doesn't mean you're going to be a successful company. Facebook did it right. They bought Instagram. So I know people are going to say, "Oh, if nobody uses Facebook anymore." That's not true. Still, I think 1.5 billion people use it. But Instagram is popular with young people.
Well, they secured their future with buying Instagram, because basically Instagram, they saw that Instagram would be the Facebook for the younger generations. So with buying Instagram, they bought themselves like 20 more years or 30 more years of knowing that they could migrate all of their primary functions to that platform and have it take over the role of Facebook. I think that's what they saw.
Yeah, and that's considered maybe not the best, but one of the best, possibly the best in some people's eyes.
The best
acquisition ever. Instagram, because they pay
we'll see. I think WhatsApp could be one of those as well, but I think we would need to go forward in time for 20 or 30 years and see how it pans out.
Well, who knows what the future holds, but if you buy, if you bought if you bought a stock for $10,000 today, right? In year zero, and then and just and if you were getting a $2,000 dividend,
That's nice.
every year, it doesn't matter even if in 20 years you don't get any dividend at all, and you mean you already doubled, you tripled your investment. But in their case, it's like they paid $1 billion for this Instagram, and they've already made like probably $100 billion in selling ad space on it. You know, I mean, it's just like they've already made their return so many times over.
Exactly.
Even if it goes to zero at some point in the future, like if you 100x your investment,
Yeah,
it doesn't
and
matter.
it's also the thing where it was a competitor. So even if it goes to zero, but they spend $1 billion to eliminate one of their competitors, it's worth it.
Yeah, but I mean,
So
it's a total win-win because they've been like crushing it on the return. But in that case, if you did the $10,000, they've already made probably like I would say 30 an equivalent of 30,000 a year in dividends. They already like so it's not even like
yeah.
But that's why you invest in companies, because you have faith the management will do the right thing. Not all companies, like when there's new technology or a new company, they just lay down and die. You just have to figure out how to evolve. If you're a farmer and it rains every day and it's your crops are flooded, then you have to just start selling umbrellas. You know, you have to figure it out. And I think Meta does a good job at figuring
I can
things
give a
out.
great example of a stock that we could check for a moment that is trying to do that. I own it. It's called Medifast. You might know it. It's in the weight loss industry.
Medifast?
So I bought it. Medifast, yes. It has it sells weight loss products. Medifast.
Oh, Medifast.
Medifast, yes. So they're trying to reinvent themselves because I bought them before you had these weight loss drugs, Wegovy and other stuff. So before that time, they were churning out
Like
a return of
Ozempic?
40% per year. Yes,
Is
yes. So
that like what they do? Sell a similar type of drug as Ozempic, or
they don't sell drugs. They sell like they have coaches and they try and help people, and they sell like bars and other things to and
like
a
fitness?
course basically to help people lose weight. And they're still trying to do that. So they are an extremely healthy company in terms of margins and no debt, anything. They have a good management. And they were basically returning 40% per year for a stockholder for a long time, and especially since 2015. But then all of a sudden, like 1.5 years ago, you had these weight loss drugs. So now it's basically something that the business has to figure out, because otherwise they're gonna roll over and die, because it's a giant competitor for them, those weight loss drugs, and they don't sell those. But they then you can really see if a business can stand the test of time, because they are gonna take action. So they cut their dividend, they are doing other things, they made an investment in another company. So you can then see from the actions of the management team after something like that happens if they are a good company. Because if they would have just said we're going to continue the dividend and continue like nothing has happened, then you can say, well, it's terrible, because they don't see what is right in front of them.
Yeah, that's it's how you react to things.
Yeah. And most people they react normally to danger, just like companies, because the people in those companies they see the danger for the place they are working for. It's like seeing a lion on the road and thinking, most people would run away, just like or try and kill the lion or something. And companies should react in the same way. And if they don't, they are suicidal.
Yeah, it's interesting. I generally wouldn't think of a company like this as a good investment.
It was
But
2 years ago.
that doesn't mean it's yes, selling weight loss. Weight loss is a huge industry.
Yeah.
It's a crowded industry, but it's a huge industry, and their revenue has grown pretty dramatically. They must have done some acquisitions to grow like this.
No.
It's organic?
Yes.
That's amazing.
Yeah.
Do you hear that, guys? This is organic.
And it's recurring. And it's recurring revenue. And they had a gross margin of 70%. So it's really high. I don't care about the net margin. It's only like 10%, but because they have so much recurring revenue, it's fine. It's just like so they operate now. It's like a 500 million market cap, and they didn't need any debt. They have like a cash position of 140 million, I believe, and they reinvented their business model a little bit 5 years or 6 years ago, and that's why you saw the huge jump. They focused on coaches and selling weight loss products, and because it's such a huge industry in the United States, because so many people are obese, they have endless target market.
Hey, come on.
Well, a lot of people are compared to Europeans.
No,
That's why.
True. It's true.
Yeah.
Yeah, we overeat. Our portions are huge. Well, the revenue has really come down a lot.
Yeah, now it has. Yeah. But before that, it was, growing at 15-20% more even. So this is a case where I'm holding and I'm not gonna, it's not like Intel. They have time to turn around. They can survive.
You get a nice dividend. It's like
12, no, they
13.
cut it. They cut it completely because they saw the weight loss drugs, and the dividend was quite high because they were such a safe business. But then they were basically raising it every year. So then they cut it to try and figure out how they are gonna reinvent the company to grow their business again.
Wow.
Yeah.
Anybody invest in this company? On this?
You can watch a YouTuber, More Money. He invested in the company as well. He's a YouTuber like yourself. And I saw this company on Magic Formula. So I was quite interested in it because it was also turning up in a lot of my screeners because it was so profitable and financially stable.
Yeah, like Pet Med Express, that was coming up in my screeners.
Yeah.
I'm down 50%, but hey, Gav. Yeah, we've been live for an hour. Let me know in the comments if you're here. I could do a raffle. Yeah, John Michael said, yeah, Google bought YouTube. So yeah, that was a great acquisition. What a cash cow YouTube is.
That's the ultimate cash cow. And seeking alfalfa, yes, Medifast has trouble with regulators, but they try and stay ahead of that by basically being they are quite a good employer, I've heard, and they try and work with their regulators. So they had a case where they violated some rules, but they settled it fast and work with the regulators in order to have a safe business, basically, because they don't want to be in the crosshairs of being named a multi-level marketing company. So a lot of people say they are a multi-level marketing company, but they aren't. Their business model is a little bit different. Because their coaches, they don't hold any stock of the weight loss products. So it's not a pyramid scheme, although it seems like it.
So yeah, it has a pretty high short.
Yes,
17% short
that's
interest.
because it's it seems like a multi-level marketing company, which is something people don't want to see, but it's different. I looked at their model.
Yeah, a lot of things do seem like multi-level marketing, but if you think about a business, most businesses are structured a way where it appears like multi-level marketing, but it's a legit business.
True. Yeah.
Because as people on the top, as people make money, it rolls up to the people on top. Like any business, it does. The CEO of any company makes more money the more sales the business does, and then the second in charge makes more money. Yeah, everybody on top makes more than the people on the bottom. That's just how a company is.
Yeah. Yeah. Which
Microsoft.
can be quite dangerous for a company to, for the Intel CEO Pat Gelsinger, he's paid, I think 100 million per year or something.
Yeah,
So the bigger a company is, it can force bad management, compensation or packages or other things that you have to take into account that you don't have in smaller companies. Or if you have, well, then it's just only for the management to enrich themselves. So that's a problem with larger companies that you can have. But some of those practices can be really good. I don't know if you what's this company called? Paycom Software.
Paycom.
Yes,
Oh,
it's a company.
yeah.
Basically, it's automatic payroll company.
Oh yeah, like Paychex.
No, like ADP.
ADP. ADP.
Yes, it's like that company. They are a competitor of ADP.
Well, Paychex
So
is like is a
it's
payroll
safe.
company.
It's also recurring revenue. So,
Yeah.
but in that case, the CEO, he's paid in stock awards only. I heard, or a lot of stock awards, and the salary seems very high, but the salary is tied to the stock performance that he wants to see in a number of years, and he's paid in tranches of the when he meets the stock price targets, uh, um, for his company, and he founded the company himself. So
Yeah.
that's also something, he doesn't want his baby to die, and he also probably doesn't want to take too much advantage of that, even though it seems like he's paid excessively. But I think, that could be a case where it isn't. And the stock price has done really well. It's like 50% per year up. So that's a tricky one, because it
Yeah.
seems really expensive, the company. It has like a PE of 30, I believe, or 25. But sometimes you just have to bite the bullet and buy a good business for a high price. And that's also something to learn.
Yeah.
Yeah,
That's
Chad Richardson, he's the CEO. Yeah.
John Michael won the raffle, a $20 Amazon gift card. So John Michael, make sure you email me at this email address. The thing is, if you build a successful business that's profitable, that employs a lot of people, I think you deserve to be rewarded.
Yeah.
And whether it's cash from the business, whether you get a nice salary, nice bonus, or whether stock options, you deserve it. Now, if you run a business, if you start a business and run a business that's losing money year after year, and which means your investors lose money, then you deserve a salary because you need to live and eat. But I don't think you deserve a bonus or
Yeah.
much of a bonus at all, even
Yeah.
though I'm sure they take it. If I was running a company, I would want it all tied to like stock and how profitable the company is. So if the company makes $1 million in profit, maybe I deserve a $50,000 bonus. And if it makes 100 million in profit, I deserve maybe a $2 million bonus. I don't know. Like, it would be tied to how profitable the company is. So if people have a question, oh, why do you make 2 million and your employees only make 80,000? I say, well, because I have the risk. I might not make anything if the company doesn't become,
Yeah.
But
True.
there's always gonna be people complaining no matter what you do, unless you don't take a salary at all. That's the only way people won't complain.
Yeah. And a great CEO, he would give his money back to the company if he saw that it was in financial distress. If he believes in it, he would say, I forego any payment this year. I'm going to give it back to the company if it's like 20 million, 30 million or something, to see and to use that money to turn the business around. A lot of people wouldn't do that, I believe, but if you really believe in it, then, or it was a founder of the company, he might make that decision. So that's why I really like the businesses that are still led by their founder.
Yeah, like Warren
Because
Buffett.
it's exactly, and it's a little bit like their child, or sometimes they care more about their own company than their child. So I don't know how you felt. Well, you owned a company, right? So how did you feel about it? Would you have given your money back to your company if it was doing bad, but you believe that it could pull through if you were paying
You're asking
yourself?
me?
Yes.
Yeah, I mean, I would keep the money in the company so there's less expenses, so we can potentially grow and become profitable. But I would probably make enough money where I can eat and pay my rent, but it's hard because everybody has a different starting point. Because if you start a business where you're already in debt, you're probably not going to make the best decisions because
True.
you always need
Yeah.
money. But if you start a business where you already have $1 million in the bank for yourself, then you probably can make a lot of wise decisions, even pull money from your pocket if you needed it for something.
True.
So that's why when you invest in a company, looking at the people run it, if they in their personal lives aren't doing well financially, they're probably not gonna. The business probably won't do well financially.
Yeah.
Because generally, people who have a lot of money are good at managing their money, and people who don't have money are bad at managing money. Generally, there could be some situations where if you have a lot of money just because your parents had a lot of money, so that's not you. That doesn't mean you're good at managing money. Your parents were. But generally, if you have a lot of money in the bank, you're probably better at managing your finances than someone who has no money in the bank.
Yeah. True. That's why it's so bad for, a lot of people are in credit card debt in countries. But basically, if you are in a lot of debt, it ruins your long-term thinking.
Yeah. And you
To
make poor
a large
decisions.
degree.
I
Yeah.
don't know if anybody's gone to casino with money they needed. They needed
That's
money to pay
painful.
rent. What's
Yeah,
that?
that's painful. That's really painful.
And
Most
I've
people
done
wouldn't.
that before, and I never win. I always make the wrong decisions. I always hold back on when I should bet more. So when you're not worried about money, if you have already like 50,000 in the bank and you go to the casino with $500, you're probably going to be fine. But if you have 2,000 in the bank and you go to the casino $500, that 500 you kind of need. So exactly, motion scored is the biggest mistakes. And it doesn't seem like it, but I think everybody knows what I mean with that. Who I thought I saw Warren Buffett makes. I think his salary is $1. Who his salary is $1? Anybody else know?
No. His salary is like 200,000 now.
Oh right,
I believe. Yeah, he raised his salary after a long time.
100,000.
100,000. Okay.
It says here 100,000.
Okay.
So he makes $100,000 a year. Which is he deserves obviously a lot more than 100,000, but I think Zuckerberg makes $1. He's always made $1. Well, not always, but at least since 2018. You got to respect someone who makes $1. Obviously, his total compensation is 27 million, and now with the dividend, they're going to pay their first dividend, and I think based on how many shares he owns, I think he gets $700 million.
Yeah, per quarter.
Per quarter.
Yeah, I think so, or per year, something like that. A couple of hundred million per quarter.
But why does he deserves it? I mean,
yeah.
There's nothing wrong with that. He helped the company become profitable. He pays. How many employees do they have? Like 100,000?
20,000 or something? 30,000?
He employs 67,000 people. They all get paid. The investors are now getting a dividend. So of course he deserves it. Just because someone makes a lot of money and there's lots of poor people doesn't mean that's not fair. He should give all his money to the poor people. But I guess that's a different topic.
And I have a question for you, Scott.
Yeah.
Do you use mental models often?
Mental models?
It's something that mental models. It's something that Charlie Munger talked a lot about before,
like in your head, just calculate things in your head.
Well, not. It's also, for example, like cloning or looking at a business model that works in one country and then trying to find a business model similar to that in another country to, find investment ideas. That's a lot how I look for good companies. Once I combine it with screeners to look for potential candidates to invest in. So I found like the Ulta Beauty of Australia, but then for candles and stuff. So that's something that investors can apply because you can find hidden gems in that way. It's quite a good tactic to use.
Yeah, no, I never heard of that. I guess to a certain point I do that because I try to look for scalability and businesses that make sense. At least I think they make sense. And scalability. Those are probably the ideal type of companies. Like if you sell, if you're a supermarket chain, that makes sense to me because everybody goes to supermarket. Well, almost everyone goes to supermarket. That makes sense. Scalability is not as easy. It is somewhat scalable, but it's a little more tricky. That's definitely the most important thing when I look for business is things that I think are logical. Like that, like the what's that business? You get a box in the mail, and inside of it is like a dog treat, a dog toy.
Oh yeah, that's really scalable. Yeah.
And I get that, but I don't think as an investment. I mean, as a consumer, I liked it, but as an investment, I don't think I don't think it makes so much sense. I think if you own the company, it could employ you. You can make a nice living, maybe your family and a few friends you can employ. But as an investment, I didn't see the potential there. Because I just don't. It's limited. You have to have a dog. You have to be willing to pay for this box that you don't really need. You need dog food and you need dog medication, but you don't need this box. It's a nice to have. So I didn't see the value of investment. It was a SPAC, I think. It came out as a SPAC, and you can see it's down like 95%. So I have to at least.
But if they can become profitable, then the upside is clearly there, because they do have a large market and a lot of people are willing to spend a lot of money on their pets. So that is something that is why I think you looked at this company.
No, I just got the box of my dog.
Oh, okay. Yeah, sorry.
and then I saw they became public. But I mean, I wouldn't, if someone made a case why they invested in it, I wouldn't say you're wrong, because there's plenty of stocks out there that like Palantir. People love Palantir, and I don't know, it's a little confusing exactly what they do. But there's a lot of businesses that I'm not, and I was invested in them at one point, and I kind of lost faith.
So would you sell Wix, or would you buy Wix, which is a web developer? You can build your own website on it. Yes. It's owned by some super investors as well.
Yeah, I think the idea, I think it makes sense, and I think even as a business and investment, I think it makes sense. So it passes that test. But I'm not sure. I'd have to look at it more, because they have a lot of competition with. There's a couple of companies that kind of control this market, right? Because they help you build a website. Is that how it works? And then you could sell things on the website?
It's you can build your own website on it, and it's a freemium model. And there are other companies that do it, like what's it called, Shopify and stuff. You know, those kind of companies.
Shopify is big. Is really.
But they are. It's kind of different, because Shopify is more for having when you want to have an online business, and Wix is when you want to start a business, when you are, for example, a hairdresser or a restaurant or something like that. And they have a really high, the switching cost is really high. Once you have your website for your company running, you're not going to switch to a competitor.
That's a good point. That's like barrier to entry is another thing to think about. Kind of like Uber and Lyft. Like, it's very easy for you to go to Uber, to switch from Uber to Lyft. A lot of people do it the same day. But switching your website is not easy. It's kind of like switching your bank is really painful.
Or your phone.
A lot of those things. It's just it's a lot of switching your credit card. It's just so much work, and you don't want to deal with it. So you just stick with your current company. So that's a good point. If they can build market share. So how do they make money? They charge a fee.
So you can make a website for free, but it lacks all of the functionalities, or a lot of the functionalities. So let's say you want to sell stuff because you want to start a business, or you started a business and you then want to sell your products online. If you want to add functionalities to it, for example, payment functions, or website in your website certain like being able to book a table or other things, then they charge money for that. So for the extra functionalities, they have a recurring revenue model.
Right.
So that's how they make money. So it's really they keep really good track of how many people they can turn from unprofitable customers into profitable customers. And once you are a profitable customer, you almost always stay a profitable customer, because the chance of you leaving is really low, because they have really perfected their business model at this point. So they are a really good example of a really self-perfecting SaaS company, because if you leave their site and you stop paying for having a website, they really have a good system in place to try and figure out why you left. If it is for example, because a certain functionality was lacking, they acquire that knowledge and then they build the functionality, and then they try and prevent other people from leaving in the same way. So that's why it's continually improving, and that's why their customers are really happy with them. So I bought them right after the COVID peak, because then you have a lot of these companies that go up a lot because they have the demand pulled forward, and you have the trough afterwards. So you see like a revenue increasing 5% instead of like 40%. So the stock price cratered, and I bought it at $80 per share. But my belief is that this company could be, as they have a really large target market for small and medium-sized companies, and they are profitable this year, and they're already buying back stock. So this could be a company that can, I don't see a limit for this company. They can grow to 70 billion, and it could still continue growing. It's a little bit like a Meta, but then for websites, in my view.
Yeah.
So that's why it's so interesting.
Yeah. So when you guys see this, obviously they were pretty new, and then they were growing, and then it took off. It went from 100 to 350. So when it comes back down to 100, now it's in the low hundreds. So some people, this is how most people do their due diligence. They look at how much it was in the past, and they say, okay, it was 300, now it's 100, so it has 200 points to go to get back up to there. So that's how they do their due diligence. But you should think of now. You should say, should it have been up 300? Should it have even hit that level?
No.
Maybe it should have only been 100, and then it was artificially higher to 300, and now it's where it should be trading, and that's why it's staying in this range. If you come to that conclusion, like you feel based on your due diligence, $100 was the right range, it's just the market was out of control, and that's why it came down. Or like in a case of when Netflix came down.
Yeah. And James has another good remark. He says they also make money by having third-party developers create and sell apps within Wix. So that's a functionality that Apple uses as well for their app market.
Third-party developers create and sell apps within Wix, generating additional revenue.
Yeah.
Okay. Yeah. The app market is huge. Yeah. So I mean, I definitely see. It's a huge market, and it's going to keep growing. But remember the apps is a big market. But things change so much, because remember, websites were the only thing at one point, and then
yeah,
And then you would think, okay, websites, like that's the future. You need a website. It's the only way to sell things, and that's the only way to like grow your business. And now apps are kind of like
the new frontier.
the new thing. So who knows
Yeah.
what the next thing is? But I do see it's a good product. It makes sense. There's logic there, and the scalability is great scalability. That's why tech companies are so profitable, because the scalability is just through the roof. You know, Tesla is not really a tech company, but they're more like a meme company. That's why like GM and Ford, they've been around 100 years, and they're not huge companies because it's not a profitable business. Selling cars is not an easy business. It's expensive. It's scalable to a point, but it's not nearly as scalable as a company like this, or Netflix is extremely scalable too.
I mean, there is one good example that I can think of that does it kind of in the right way, and it has a lot of support, BYD, but it's only because they are vertically integrated and they build their own batteries. And Tesla has the kind of the same thing. That's why they are. That's why I think they are winning from all of these companies, because they try to be vertically integrated. So that's something you can look at in a lot of companies. Are they vertically integrated to increase their margins because they do more things themselves to integrate it into their own business?
Yeah, no, it's true. It's true. That's another way to, if you control all the, all the steps in the process, which is what vertically integrated is. Then your margins could go up a lot, and But then sometimes you feel like, am I spending too much on this one part? So
it could be.
It's a balancing act. You got to see.
Most often, it's when they try to integrate something like that, it should be critical to their normal operations. So, for example, if you build a car and then you think about, well, would it be logical for me to also build the door of the car myself instead of buying it from a supplier? Then it could be a good idea to buy it, to manufacture it yourself. But if it isn't, then it doesn't make sense. So that's if it's components that are very expensive to buy. For example, I own Malibu boats. They build boats, and they are trying to become more vertically integrated. So Malibu boats, yeah. And this is it's the top. I think you might have analyzed it once, but I'm not sure.
I don't remember.
So they build speedboats and stuff in the United States, and they compete with what are they competitors? Mastercraft boats, those kind of companies. I think you analyzed Mastercraft once. So they build a lot of their boats, and then they are trying to bring more of their component manufacturing in-house. So they now also build their own engines for the boats. And instead of buying all of them from General Motors, I believe. So they're really trying to work out what kind of stuff they spend a lot of money on to actually build a boat, and then they bring that in-house. That's kind of how they roll. So you can tell normally that it's a good business if they first of all have those, it pops up on a screener and then you see it has high returns or something like that. And then you can see if they try and bring something in-house. And in a lot of cases, it could be that they do it because it's logical for them to do so. And some companies are really well versed in that kind of game.
Yeah. sometimes it could, increasing your margins, taking all the profit for yourself. It could make sense. Sometimes it's hard to figure this stuff out, though. Like, should they be making, if you mow lawns, you have a lawn mowing business. Is it good to start making the lawnmowers yourself, or buying it from third party and just focusing on the service? I mean, it's just like,
yeah.
I guess if you can do something yourself, like if you could make the lawnmowers, maybe it'll be good. But then you start thinking, that's a lot more.
Yeah.
But yeah, no, that's interesting. Okay, I think I think we got to end soon. But yeah, this was good. If anybody wants to do a live stream with me, I think you'll enjoy it and probably learn from it. Just email me. And thanks for joining and giving your insights.
Yeah, and it's a lot of fun. Thanks, Scott.
Yeah, definitely. And anybody have any closing questions before we get off, or? Probably not. They probably would have asked already.
Yeah.
Yeah. Okay, great. So so thanks everybody for joining, and thanks Tim, and I'll talk to you guys soon. Okay.
All right. Have a great evening. Ciao.
Okay. Bye.